Imagine this. Every global crisis you've ever lived through, from housing crashes to sovereign debt defaults, from pandemics to inflation surges, seems chaotic, unpredictable, even terrifying. Yet, if you peel back the headlines and the panic, a pattern emerges. The hidden financial empire doesn't just survive crises, it thrives on them. They profit when ordinary people lose, when governments scramble, and when economies falter. Who are they? How do they operate? And why does history seem to repeat itself, as if the same invisible hand is playing a game with billions of lives? Today on Finance TED Official, we're going to uncover the shocking mechanisms behind this hidden empire, trace its origins, follow its rise through every major economic collapse, and reveal the patterns that repeat decade after decade. By the end, you'll understand not just how crises happen, but why the same power structures always benefit. And you'll see how this pattern is shaping the world right now, including you, whether you realize it or not. Setting the stage, understanding the system to understand the hidden financial empire. We first need to understand the ecosystem it operates in. This empire, isn't a single person or even a single institution. It's a network of banks, hedge funds, shadow institutions, and global financiers that manipulate liquidity, leverage, and systemic fear. Key features: control of credit and liquidity. Central banks and private banking networks act as the gatekeepers of money. When crises hit, they decide who survives. Derivatives and financial instruments. Complex contracts and opaque instruments allow massive profits for insiders, while outsiders bear the losses. Crisis as opportunity. Every crash, whether housing, commodities, or debt, creates distressed assets that these players can buy cheap and flip for enormous returns. Teasing the twist. History will show that regardless of whether the crisis is political, economic, or health-related, the beneficiaries remain the same. That's not conspiracy theory. That's the repeating pattern of modern finance. Origins. The hidden empire emerges. To see this empire's origins, we need to go back to the late 19th century. 1. Early banking dynasties. Families like the Rothschilds in Europe and the Morgans in the US weren't just bankers, they were the engineers of financial crises. Why? Because access to capital meant access to influence. Example. The Panic of 1893 in the United States was a banking collapse that allowed J.P. Morgan and Associates to reorganize railroads, consolidate debt, and control critical infrastructure at bargain prices. These crises weren't random. They were leveraged opportunities for those with the knowledge, connections, and liquidity to profit while the public panicked. 2. The rise of centralized banking. The creation of the Federal Reserve in 1913 institutionalized a system where crises could be managed but also exploited. With the Fed controlling the money supply, it could inject liquidity to save banks, but leave everyday citizens exposed to inflation or unemployment. The 1929 crash and subsequent Great Depression illustrate this perfectly. Massive speculation and leverage fueled the boom, and the collapse enriched insiders who shorted markets or bought distressed assets. 3. Lessons hidden in plain sight pattern. The rich and connected always survive. The rest bear the cost. Mechanism. Credit manipulation, insider access, and strategic buying of distressed assets. The foundation of the modern financial empire was built on these principles, and they've persisted for over a century. Rise. Crises as profit engines from the post-World War II era to the 2000s. Every major crisis reinforced the same pattern. 1. Oil shocks of the 1970s. When oil prices quadrupled, governments and ordinary citizens suffered. Yet, hedge funds and energy traders leveraged futures contracts and derivative bets to profit immensely. Example, large banks and trading houses created instruments that allowed them to bet on volatility, making fortunes while inflation and recession spread. 2. Savings and loan crisis 1980s, 1990s. The US government insured millions of savings accounts. But when banks failed due to risky lending, taxpayers footed the bill. Meanwhile, insiders bought distressed bank assets for pennies on the dollar, consolidating financial power. 3. Dot-com bubble 2000 and 2008 global financial crisis. Both crises show the same hidden mechanisms, over-leveraging, and speculation create bubbles. The public invests in assets they don't fully understand. When the bubble bursts, government bailouts save the system, but the empire walks away stronger. Key takeaway from this section: crises aren't just accidents. They are profit engines for those with foresight, capital, and access. Breaking point: systemic vulnerabilities exposed. Every empire reaches a breaking point. 2008 crisis. Subprime mortgages triggered a housing collapse. Banks were too big to fail and governments bailed them out. The public lost homes, pensions, and jobs. The elite gained assets and influence. Eurozone debt crisis. Greece, Spain, and Portugal suffered austerity. Meanwhile, international banks and funds collected interest, fees, and leverage on distressed sovereign debt. These breaking points reveal systemic weaknesses, but ironically, these weaknesses reinforce the empire's power because they create opportunities to consolidate wealth and influence. Fallout and failed fixes after each crisis. Reforms are promised. Dodd-Frank after 2008, Basel III, tighter financial regulations. History shows that regulations are often circumvented. Financial instruments evolve faster than oversight. Bailouts ensure the system remains intact, preserving the empire's core. Examples: hedge funds moved operations offshore to avoid oversight. Shadow banking networks grew unregulated, untouchable, and highly profitable. Quantitative easing post-2008 enriched asset holders, while ordinary savers saw stagnant wages. Pattern: every fix reinforces the system rather than dismantling it. Modern parallels. The pattern repeats. Look at today. COVID-19, inflation, energy shocks, geopolitical instability. Big banks and funds profit from market volatility. Hedge funds buy distressed assets created by lockdowns or supply chain disruptions. Governments inject liquidity, but ordinary citizens face inflation, unemployment, and debt. Shocking data. Since 2020, global billionaires have increased wealth by over $3.5 trillion, while millions of households have lost income. Stock buybacks and corporate bonds soared, enriching investors, not employees. Pattern confirmed. The same empire benefits, the same cycles repeat. Every crisis feeds the same hidden financial machine. Takeaways: crises are engineered opportunity zones. For insiders, disaster is profit. History repeats because mechanisms are embedded. Credit control, bailouts, and shadow finance ensure wealth concentration. Transparency alone is insufficient. The system evolves, and only strategic awareness and diversified planning can protect ordinary citizens. Warning: open-ended thought: every new crisis isn't random. It's a reminder of systemic vulnerability, and the same elite networks benefiting from past disasters are likely positioned to benefit again. Ask yourself, are we passive observers, or can we understand and strategically adapt to a system that thrives on chaos? If this breakdown challenged what you thought about financial crises and the hidden empire behind them, hit like, subscribe to Finance TED Official, and share your thoughts below. Which pattern shocked you the most? This modern crisis is already feeding the empire's next cycle. Let's start the conversation. Because understanding the empire is the first step toward protecting yourself and maybe one day changing the game.